Hey everybody, welcome back. I'm Russell Cunha with 3B Mortgage Brokers, and today's topic we're going to be discussing how to improve your credit score. We're going to be going over 8 different points today of things that you can do to improve your credit score to help you in any type of financial situation that's going to require you to have better credit. And better credit can lead to a much better life. I'm not saying it's going to completely improve your life, but it does make things easier. Credit scores are used for all kinds of things. I had to go through get my credit score done just to get my license because I had to make sure I had good credit. A lot of times credit is used for when you're applying for a job. They want to make sure that you're okay with money, especially if they're going to trust you with that. But today, let's get into it and go over our 8 points and figure out how you can improve your credit score. All right, first point. You need to know where you stand. So getting started in that, if you don't know where you stand, let's say you went to the grocery store to buy groceries, but you have no idea how much money is in your bank account, well, then you don't know whether you're going to be able to afford all of the groceries that you're getting. Similar here, you want to know what your credit score is to see what you can qualify for any type of financing. So you need to check your credit reports at all 3 of the major credit bureaus, Equifax, Experian, TransUnion, or you can get it for free at the annualcreditreport.com. The major credit bureaus are using FICO. Now, they are also probably going to charge you to get this credit report. But if you go to annualcreditreport.com, you should get all 3 of your credit scores. Now, they will not be ones that can be used for a mortgage, but they are general. There's a whole video on that about what we're doing, about why some use Vantage and some use FICO and the differences and what you need for a actual FICO score for a mortgage. Anyway, so that's the place to start. If you go to annualcreditreport.com, you'll get your 3 different numbers, and you will also get a report that's underneath it. And the top of it's going to show all of your derogatories, and that's what you want to know about first. We need to know what derogatories you have on there, if any. Also, going through that report to check over all the different things that are being reported on your credit report, you definitely want to know that, because there could be some things in there that you just didn't know or forgot, or there's an error. Someone may have gotten a hold of your social security number and they're using it, and it's dragging your credit and good name down because they've committed identity fraud. So that's one of the reasons you want to go and check this. Outside of that, you'll get that top section that's got any derogatories on there. If you'll keep that credit report with you whenever you come to me or to anyone else that you're looking to get a mortgage through, they'll ask you, do you know your credit score? And, it's going to be different when we have to actually pull it for our mortgage numbers, the FICO scores. But it gives us an idea of what we're dealing with, and we can start looking to solve those problems early. So that's kind of one of the reasons you want to go ahead and get that for your own peace of mind and to give you an idea of where things are at. Also, maybe it's free and clear, but we need to see why you're not sitting at a 780 or 800 credit level if you've been paying everything on time and been doing everything right. So let's dig into it and figure it out. So number 2, pay your bills on time. That's a big one. You've got to get your bills paid on time. Late payments will hurt you so much. Your payment history makes up 35% of your credit score, and it is the biggest factor. Even one 30-day late payment can drop your score significantly. If you prefer, you can set up auto pay or reminders to make sure that nothing slips through, because that's the last thing you want, is to have anything slip through and not get paid and you're not aware of it. Because when that happens, it starts getting reported and we see, well, how many 30-day lates are on there? If it has it turned into a 60-day late. I dealt with a borrower just a while back who happened to have been in a car accident And after the car accident, they were fine. They decided they didn't really like their car insurance company, so they decided to get new car insurance. But they didn't cancel their old car insurance, and it was on an auto pay. So the insurance company, but she had the credit card company stop paying it, but she didn't cancel it with the insurance company. That was their fault. It happens. But they sent the delinquencies to a collection agency, and the collection agency had it and kept reporting 30, 60, 90, 120-day lates. And it was for this small amount. She owed like $400 or $500. So she went and contacted the credit agency and got that taken care of. We're going to be covering that here in just a minute. So you want to make sure that you've got this stuff taken care of and that you're looking through your credit report. That's why it's important to get this done. So, like I said, even one 30-day late can drop your score significantly, and this weighs 35% into what your credit score is going to be. So, number 3, lower credit card balances. A lot of people, times have been tough. So we're living off of credit cards, which drives up those credit card balances to their limits, and people will make a minimum payments. The closer you are to that limit, the lower it's going to start to drop your credit report, your credit number. Anyway, so credit utilization. Credit utilization is how much of your available credit you use, and it makes up 30% of your score. That means that if you have a credit card limit of $5,000, but you owe $4,900 on the credit card, even though there's still $100 difference between your maximum and what you actually owe, that will drive your credit score down. They don't like that. That means you're maxing it out and not paying it off. So to avoid that, try to keep your balances below 30% of your limit. Ideally, you want to keep it under 10%. But if you can hold at that 10% range, let's say you've got a limit of $1,000 and you've got $100 charged to it. That's your 10% right there. If you'll roll that over into the next month, just keep rolling it over month after month, holding that 10% level, that will skyrocket your credit. The credit agencies love it. So do the credit card companies, because it shows that you have credit and are responsible enough with it. Plus, you're rolling a balance that they're going to charge you, let's not kid ourselves, anywhere from 18 to 25%. Somewhere in that range. So they get to make a little money off of you, but I look at it as a fee for jacking that credit up. That's what you want right there. So next, if possible, pay down the highest balances before applying for a mortgage. That is good advice. Pay these things down. That will affect your debt to income ratio. The lower that you owe on monthly payments like that, the more room you're going to have to it sets a debt to income ratio to where you can't spend as much money on a monthly mortgage payment because you have too much money going towards credit cards and student loans, things like that. But the less you owe there, the more they'll let you apply towards a mortgage. All right, so number 4, avoid opening new accounts. That's so true. When you start looking at getting a mortgage, you want to avoid opening any new credit because they get very suspicious when they start seeing new credit accounts open up as you're trying to apply for a mortgage, because now we're back to that debt to income ratio that I was talking about. If they see that you're getting ready to go into a lot of debt, or at least that's what they're thinking you're going to try and do, it makes them very nervous, especially if it's happened just before you're applying for the mortgage. Once you've closed on your house, if you need to go finance furniture, or you've got a lake house, you want to get a boat, or you've been waiting to get a new car, great. Don't buy the new car before you get the house. Buy it after you get the house. So each new account creates a hard inquiry that can temporarily lower your credit score. So anytime your credit's pulled, that's a hard credit pull because you're getting all 3 bureaus. There is a soft pull, but hard pull is what counts. and that'll lower your score for a couple of weeks. But if you do them all within the same time period, they can see that you're actively shopping for a home. So it'll only lower it the one time, but not every time you get your credit pulled. Also, lenders also don't like to see too many new accounts right before a mortgage is taken. That's what we talked about just a second ago. And stick with your current accounts and focus on strengthening them. Yes, take care of those first. These are the ones that have your history in there, the ones you've stuck with, the ones that are being reported, because new credit's going to take a little while to just start showing up on your credit report. All right, number 5, don't close old accounts. I can't stress this enough. Do not close old accounts. Your length of credit history accounts for 15% of your score. So we're at what, 90% of your score right now. Just going into the things that we've talked about. That length of credit history is important. I deal with a lot of younger borrowers, and they've got new credit history. So we have to work on increasing that credit score. But let's say you got a credit card when you were in high school, and now you graduated college, and you're getting just offers out the wazoo for new credit. So you get one of those. Hey, it's got a better interest rate than that one I had way back in college. In high school. So you think, I'll just use the new one I got from college and I'll cancel that old one. Well, the old one from high school has 8 years worth of credit history on it, or 4 or 5. But that new one has less than a year on it. And if you cancel the old one, then your credit history goes to less than a year, because it completely wipes out all the old stuff. Now, if you've been at this a while and you've got 20 years worth of credit history, and you've got that one from high school that's hanging around forever, you can get rid of it at that point. But new borrowers and anyone who's newly establishing credit, say you come out of divorce, you've got things fixed up, keep those old lines of credit and then take care of them. Also, closing old accounts can shorten your average credit age and raise your utilization. That's what we just discussed. You don't want to do that. Keep older accounts open, even if you don't use them often. Anyway, all right, next, number 6. Mix of credit helps. Having both revolving credit cards, and installment loans, auto, personal loans, student loans, helps your score. So what you've got is you've got revolving credit, a credit card. That's something that's going to, you can charge on it, pay on it, and then you can still continue to charge on it. That is revolving credit. It doesn't go away. But an installment loan will go away. You can pay off a car, pay off a personal loan, pay off your student loan. Paying off those loans helps improve your credit score, but they're looking for a mix. And like it says here, don't take on new debt just to get the credit mix. You don't want that. Not while trying to get a mortgage. But if you're not ready to get a mortgage and you're just looking on working to improve your credit score, fine, go ahead, do something like that, but make sure it's well within your budget. You can afford it. You do not want to put yourself in loads of debt. Don't take on new debt just for the mix, but know that lenders like seeing you manage different types and responsibility. So that gives you both sides of it. The responsibility, that's really what they're looking for. Your credit score is just a responsibility score. Do you handle things correctly? If there's hiccups on there, they can be fixed. Number 7, settle collections. Here's some of those hiccups. Settle collections strategically, and that is important to do it strategically. If you have a collections, ask for a pay for delete agreement, meaning the collection agency removes once the account has been paid in full. Even if not deleted, paying off collections can improve your mortgage approval chances. All of this is true. Now, the pay for delete, like I was talking about earlier with my borrower who had the insurance that went to a collection agency. Well, she contacted the collection agency and went over things with them about what had happened and said, hey, if I pay you, will you delete this? So they sent her a pay for delete letter. She sent them the money. Make sure you get things in writing, especially with collection agencies. You want it all in writing up front that they said they would do this, and then you do that. Handle your end of it, and within 30 days, I mean, it was quick. Usually these things are 60 days, but within 30 days, it was gone. Your credit score was back up, and that didn't have any 30, 60, 90 derogatories on there whatsoever. And we're able to get her into a new home. So that is a good story right there. Anyway, and even if they won't delete it, paying off collections helps because it'll eventually fall off your credit once it's paid, and it'll show. We can see different dates. This was paid in full, but it was 6 months ago. And at that point, we can make the argument to the lender, hey, this person's paid these things off. They've improved their life and things are changing. Now, last but not least, give it time. Number 8, give it time. Like I was saying, these things take time. Significant score improvements often take 3 to 6 months, depending on where you start. Mortgage lenders usually want to see a minimum score of 620. Some programs will allow us to go lower, like FHA, but even lower means you're still going to get a higher interest rate because your credit is so low. The higher the credit score, the lower they'll make the interest rate for you. But 680 plus opens up better rates and options, and 740 plus is considered excellent. And that is all true. If you can get to 740, you are doing great. 780 is even better. And if you can climb that thing to 820, wow. You can really start to negotiate a much lower interest rate. But there's a point when that's usually what's advertised. Anytime you see these advertisements for, oh my gosh, we're giving these amazing rates here, that's if Elon Musk needed a home loan. I mean, he's got plenty of money, plenty of credit. He just wants to borrow the money instead of paying cash for it. So it's like the gold standard right there. But if your credit score is high enough, you can also negotiate in that range as well and say, no, let's go lower. And they will automatically offer it to you lower because they want your business. But if you're barely scraping by, then they're like, I don't know. Well, I mean, we'll get you something, but there's going to be a little bit of an adjustment on you. You might have to pay a little extra or something like that. That's all lenders. It doesn't matter who it is. They're all going to look at it the same way. So let's work on getting those credit scores up. That's exactly what you want to do. Let's just say something bad has happened. You had to declare bankruptcy or something has gone sideways. These are numbers and they can be fixed. Numbers are always fixable. We may not be able to get you into a house right now, but we can definitely get these numbers moving in the right direction, and it can help improve a part of your life that you didn't think you could improve on. And financial stress it's so heavy on the American populace today. So the more you can pay down and get out of debt, your interest rates will go down, credit scores go up. All that is good stuff right there. So last but not least, let's take a review over everything we just discussed. I know I'm rambling here. All right. What do we want to know? Well, you want to know where you stand. You want to pay your bills on time. You want to lower your credit card balances. Avoid opening new accounts. Don't close old accounts. A mix of credit helps. And then settling of collections strategically. And then after all that, give it some time. Like I said, it's numbers and it's all recoverable. We can get you there. And even if you're just looking to move from a 640 to a 740, this will help all of it, especially paying down those credit card balances. That will really, really boost your credit score. So it's good to have a little bit of debt, but not a lot of debt, and that will really skyrocket your credit report, your credit scores in your credit report. Anyway, I hope you found this informative. If you or someone you know is in the market for a home loan, give me a call. I'm around all the time. My contact information is in the description below. I'll also have the link to the free credit report down there as well, and other videos that I have. Some concerning why I recommend $5,000 for first-time home buyers, and then the difference between a Vantage and a FICO score. So y'all have a wonderful and blessed day. We'll see you next time. This video is for educational purposes only and is not financial, legal, or credit advice. I am a licensed mortgage broker. not a repair service or financial advisor. For advice about your specific situation, please consult a licensed professional.